Thanks, everyone. I'm Martin Turenne, President and CEO of FPX Nickel. We're a Vancouver-based company, trade on the Venture Exchange, and we're focused on the development of a Tier 1 asset, a nickel deposit, right here in central British Columbia. Tier 1 is a term that I think gets thrown around quite a lot in this business. Generally, we use three criteria to kind of define that. The first would be you've got to have scale. This is one of the largest nickel deposits in the world. If it was producing today, it would be about the 8th largest nickel mine in the world, producing around 95 million pounds of nickel per annum, with a resource base to support that rate of mining for about 35 years. Secondly, probably more importantly, cost. You've got to be low cost to be Tier 1, and our view is that we could produce nickel here for potentially around $3 US a pound, which would be the bottom quartile of the cost curve. And finally, jurisdictionally, we think BC's a premier mining jurisdiction to build a mine of this scale. I won't dwell too long on the nickel price. As we enter 2020, the nickel market is entering its 5th consecutive year of market deficit. The market is in a period of long-term structural shortage. The world needs to start building new nickel mines, and we believe we've got a deposit that can help to balance the market in the medium term. This was a discovery that our team made, and in 2009, before any drilling had been done on it, we optioned the project to Cliffs Natural Resources, which at the time was a $10 billion major company. Cliffs came in very aggressively, drilled out the deposit, which now contains over 6 billion pounds of nickel in 43-101 resource. Cliffs delivered an economic study in 2013 and then ran into serious financial difficulties, and we were in a fortunate position to be able to buy the asset back from them in late 2015 for pennies on the dollar versus what they had initially invested. So we hold 100% of the asset now. Decar is located, as I said, in central British Columbia, in the circle that I've just drawn there. The dotted line just to the east of us is a rail line, so we've got excellent access to moving a lot of nickel to end customers. The Mount Milligan mine is located about 80 kilometers east of us, and Milligan has gone into production here in the last 5-6 years. Very similar scale operation. That is copper gold, we're nickel, but we're very similar in terms of the scale of mining and of processing. Been some question, I think, in the market over the last several years about the permittability of large resource projects in BC. Certainly that's been the case in terms of pipelines. We like to point to the recent precedent of the Blackwater project. This is a project owned by New Gold. Again, very similar scale open pit project to ours, which just recently received its federal and provincial environmental assessment certificate. So we think sets a very strong precedent for our ability to permit our project going forward. Just giving a Google satellite view here of the project, we have a very large land package. Our claims package is around 245 square kilometers. The main deposit is called Baptiste. That is already a world-scale mineral deposit, and we think there's an opportunity here to find at least one, if not more, similarly large-scale deposits within the land package. Pulling up the ore body now, just to give you a sense of scale, there's over 2 billion tons of ore that have been defined in the 43-101 estimates over time, most recent of which was done about 2 years ago. In terms of coloration here, the green shows the indicated category of tonnage, so about 85% of the resource is already in the indicated category, with only 15% in inferred. When Cliffs was operating the project, their drilling defined the deposit to about the extent that I've circled here. The best holes they drilled were in the southeastern portion of the deposit in this area. After taking the project back from them, we have stepped out, expanded the deposit in that direction, and greatly expanded the highest grade portion of the resource. And that thing is fundamental to unlocking value here going forward. So the Baptiste deposit has a lateral extent of around 2.5 square kilometers. In recent years, we've also identified the Van target as being potentially similar in scale. So the Van target, again, which sits 6 kilometers north of Baptiste within the land package, has a lateral extent of around 3 square kilometers as defined by outcropping bedrock mineralization taken at consistent 50-meter intervals. And importantly here, this is not only a larger target than Baptiste, but the grades here are also 10 to 15% higher at surface. And it suggests we've got another potential elephant deposit here. But this has never been drilled. This is something we would like to drill to see what we have here going forward. The nickel at Baptiste and at the Van target is hosted in a mineral called awaroite. Awaroite is a naturally occurring nickel iron alloy. The small reflective grains you see in the image of the core here are the grains of awaroite, the chemical formula of which is Ni3Fe. Now the key property of awaroite is it's highly magnetic. And further to that, this is a mineral that forms in a sulfur-starved environment. There's no sulfur here, much of any sulfur to speak of. And that means we've got a very clean process to produce a very clean product with a very sort of low environmental footprint from a chemical standpoint. The flow sheet that we've developed over the last couple of years has kind of taken the Cliffs flow sheet that was previously developed and made some adjustments to it. It's a very straightforward process of recovery here in two stages. The first is magnetic separation. After magnetic separation, you reject about 92% of the initial feed mass to the tailings. And the 8% of feed that remains is a concentrate comprised of the awaroite nickel mineral and the magnetite. The second stage of processing is flotation. And in flotation, we can float off a very high-grade nickel concentrate with nickel grades in the range of 60 to 65%, which would make this one of the highest-grade nickel products in the world. And the tailings of that flotation process are a magnetite concentrate, right around the 62% iron ore benchmark. So we think we've got two very valuable products that we can potentially sell into the market here. Fundamentally here, we've increased the grade of the product, and we've also seen that we can achieve higher recoveries vis-a-vis what Cliffs had previously modeled for the advancement. So we take as a starting point this nickel concentrate that we can produce for very low cost, and we have defined two potential sales paths for it. One is to take the product directly to stainless steel producers. This product, because of the absence of sulfur and any other deleterious elements, means that it can be directly fed to stainless steel producers. This product does not need to go to a smelter, and as such, we can get much higher payabilities by selling this to an end customer and cutting out the smelter as the middleman. What we've shown in recent weeks is the ability to take this product into the electric vehicle battery supply chain. So I'll speak to that point now. So the nickel that sits in an electric vehicle battery is nickel sulfate. It's nickel in a chemical form. And in order to produce nickel sulfate from traditional ore types, whether they're laterite ores or sulfide ores, is typically a very expensive and complicated 5-stage process. And that has led to huge capital cost overruns in the last generation of nickel mines that were developed in the order of typically around $5 billion or so to build these complicated mines and associated processing infrastructure. We shared our concentrate with Sherritt Technologies last year. Sherritt did leach testing on our concentrates to show that we can produce nickel in a solution form, which would be suitable for ultimately the production of nickel sulfate for electric vehicle batteries. So the takeaways here are twofold. One is we've opened up a brand new market for this product where we can sell not just to stainless but also to electric vehicle battery makers. But more importantly, we can arguably do that in a manner that's more cost efficient. We've effectively compressed the number of stages down from 5 as required for the other mineral types to just 3. We think that could lend to some huge advantages from a cost standpoint. Our work this year will really be focused on the development of an updated PEA. We haven't formally guided the market on that, but you can look for that news probably in the near future. We'd like to deliver a PEA probably in Q3 or Q4 of this year. Fundamentally, we have quite a good view that will show this project in a far better light than the previous PEA that was done by Cliffs. That study, frankly, we've worn it as a bit of a millstone around our necks. It suggested this project needs a nickel price of $9 or $10 a pound to be feasible. And we're quite confident that an updated PEA will show that this is not just one of the largest nickel mines in the world, but that it will work at a very modest nickel price assumption. So please do look out for that coming later in the year. Just quickly on our share structure and chart, you can see, generally speaking, over the last 4 years, we've been in an upward trend. There are 155 million shares outstanding. No warrants on the stock. So when we've done private placements in recent years, we have not issued warrants. Management holds a very significant position, around 18.5% of the company, and our current cash position at just under 2 million is enough to fund that updated PEA and allow us to do all of our planned activities for the rest of 2020. This kind of summarizes the thesis here, and thanks again for your time.